This summary covers the key details of Paychex's fiscal 2025 Q3 earnings call. Overall performance and financial highlights. Paychex reported a solid third quarter for fiscal 2025. Total revenue grew by 5% to $1.5 billion, and excluding the impact of the discontinued ERTC program, this growth accelerated to 6%. Diluted earnings per share saw a 4% increase, while adjusted diluted earnings per share grew by a stronger 8% to $1.49. The company experienced significant efficiency gains through investments in automation and technology, leading to a substantial 180 basis point increase in adjusted operating margins, bringing them to 46.9%. Key financial metrics for Q3 2025. Total revenue, $1.5 billion, up 5%, or 6% excluding ERTC. Management Solutions revenue, $1.1 billion, up 5%. PEO and Insurance Solutions revenue, $365 million, up 6%. Interest on funds held for clients, $43 million, down 2%. Total expenses, excluding acquisition costs, $801 million, up 1%. Operating income, $692 million, up 6%. Operating margin, 45.8%. Adjusted operating margin, 46.9%, up 180 basis points. Adjusted diluted earnings per share, EPS $1.49, up 8%. Year-to-date performance. For the year-to-date period, total revenue increased by 4% to $4.1 billion. Management Solutions revenue grew 3% to $3 billion, while PEO and Insurance Solutions saw a 7% increase to $1 billion. Interest on funds held for clients rose 8% to $117 million. Total expenses were up 3% to $2.4 billion. Operating margins expanded approximately 40 basis points to 42.9%, and adjusted operating margins increased by 80 basis points to 43.3%. Diluted EPS increased 4% to $3.76, and adjusted diluted EPS grew 5% to $3.79. Management's forecast for future quarters/fiscal year 2025. For the full fiscal year 2025, Paychex now expects total revenue growth to be at the lower end of their previously guided range of 4% to 5.5%. This adjustment is primarily due to continued headwinds from pass-through insurance revenues. Management Solutions are still expected to grow between 3% and 4%. PEO and Insurance Solutions are now projected to grow between 6% and 6.5%, a slight downward revision from the previous 7% to 9% guidance. Adjusted operating margin is now expected to be approximately 43%. Adjusted diluted EPS is still anticipated to grow in the range of 5% to 7%. Impact of Paycor acquisition. A significant highlight of the quarter was the definitive agreement to acquire Paycor. The HSR waiting period has expired, and closing is anticipated in the coming weeks. Paychex expects the acquisition to be accretive to adjusted EPS in the next fiscal year, with a projected cost synergy of over $80 million. For the fourth quarter of fiscal 2025, the company anticipates revenue growth of 10% to 12% including Paycor, with a neutral impact on adjusted EPS. Paycor will operate as a standalone business unit initially, with its current CFO and Chief Product Officer joining Paychex in senior leadership roles. Significant risk factors. Macroeconomic environment. While job growth has moderated, it remains stable. However, any significant downturn could impact business performance. Healthcare costs and plan selection. Enrollment in a specialty Florida at-risk medical plan decreased, impacting pass-through revenue. Employees opting for lower-cost health plans can continue to present revenue headwinds, though they don't affect earnings. Acquisition integration. Successfully integrating Paycor is crucial for realizing projected synergies and maintaining customer satisfaction. Regulatory environment. While generally favorable for the 401(k) business, changes in regulations could impact future performance. Highlights: strong revenue growth, 5% total revenue growth, 6% excluding ERTC. Significant margin expansion, 180 basis point increase in adjusted operating margins driven by technology and automation. Positive EPS growth, 8% increase in adjusted diluted EPS. Paycor acquisition, a transformative deal expected to strengthen Paychex's competitive position, particularly upmarket, and drive significant revenue and cost synergies. Improved client retention. Client retention has improved year over year, with client losses down across all employee size segments. Innovation leadership. Recognized by Fortune as one of the most innovative companies for the third consecutive year. Development of a Gen AI-powered HR copilot tool and the success of Paychex perks. Ethical business practices. Named one of the world's most ethical companies for the 17th time. Robust financial position, strong cash flow and shareholder returns. Lowlights. ERTC headwind. The expiration of the ERTC program continues to be a headwind for revenue growth. Florida medical plan enrollment. A decrease in enrollment in a specific specialty medical plan in Florida impacted pass-through revenue, although it did not affect earnings. Softer client employment levels. Employment levels were slightly softer than expected in Q3, influenced by weather challenges, fires in California, and lower bonus checks than anticipated. Most important statements from CEO John Gibson. John Gibson expressed optimism about Paychex's position in the digital and AI-driven era of human capital management, particularly with the pending acquisition of Paycor. He highlighted the company's strong underlying momentum and the complementary nature of the two businesses. Gibson emphasized that the Paycor acquisition will strengthen Paychex's competitive position upmarket, and that the combined entity will offer the most comprehensive HCM solutions from a trusted provider. He also stressed the focus on integration, with Paycor operating as a standalone unit initially, and welcomed key Paycor executives to the Paychex team. He reaffirmed the company's commitment to innovation, citing the development of the Gen AI-powered HR copilot tool and the success of Paychex perks. Finally, Gibson noted the moderation in U.S. job growth but highlighted its relative stability, emphasizing that Paychex is better positioned than ever to help businesses succeed. Most important statements from CFO Bob Schrader. Bob Schrader provided a detailed financial update, confirming the 5% total revenue growth and the 6% growth excluding the ERTC. He highlighted the 8% increase in adjusted diluted EPS and the significant 180 basis point improvement in adjusted operating margins due to efficiency gains. Schrader provided updated guidance for fiscal year 2025, now expecting revenue growth at the lower end of the 4% to 5.5% range and adjusted operating margins around 43%. He confirmed that the Paycor acquisition is expected to be accretive to adjusted EPS in the next fiscal year and provided initial Q4 projections including the acquisition's impact. Schrader also reiterated the company's strong financial position and commitment to shareholder returns. He clarified the adjustments made for calculating accretion from the Paycor deal, primarily excluding amortization of intangibles, stock-based compensation, and one-time transaction costs.